Good morning and welcome to the Morrows Private Wealth Market and Portfolio Strategy Update for Tuesday, 5th of May 2020. My name's Chris Molloy and I'm the Chief Investment Officer for Morrows Private Wealth. Today I'll provide an overview of where we are in the market cycle, discuss the key factors driving markets and how they're shaping our short and medium-term outlooks, and lastly, review the investment strategies that we're considering for your portfolio as opportunities arise in the coming months. Broadly, I'd like to spend 15 minutes on the market, 15 minutes on the portfolio strategies and opportunities that we're positioning for your portfolios. Where we are in the economic cycle is important, as it determines how much risk we should be taking and which asset classes will provide the best risk-adjusted returns going forward. As it stands today, we are clearly in recession phase, and in our view, we have not seen the worst of this recession as yet. Accordingly, we recommend positioning portfolios with a defensive tilt. But that said, there will be a time in the next few months to take more risk and position portfolios for the next recovery phase. I'll now provide an overview of the current macroeconomic environment and discuss some of the key market drivers that we are monitoring with regards to our portfolio strategy and implementation decisions. Volatility's fallen from levels not seen since the GFC in 2008, but it remains elevated on a historical basis. During the GFC, volatility peaked well before share markets bottomed, and there is the possibility that we have already seen peak fear for this current environment, but not necessarily seeing the market lows as yet. Whilst the US share market fell 34% and the Australian share market fell 37% from peak to trough through March 2020, the rebound off the lows has been just as extraordinary as the fall was. But what concerns us is that despite share market falls, valuations are still not cheap and do not represent compelling value and a buying opportunity at current levels. During the GFC and European debt crisis, valuations fell towards 8 to 10 times on a price to earnings multiple basis. And whilst valuations fell to 12 to 13 times in March 2020, they are now sitting back up at historically high levels. The question we ask is whether today's valuations reflect the reality of the current economic downturn and collapse in corporate earnings. In April, the US share market just had its best month since 1987, as shown in the chart on the left. Whereas the chart on the right shows the correlation between global manufacturing, being the gold line, and global corporate earnings, the blue line, very highly correlated, with global manufacturing expected to fall towards -30 on the left axis. There is a high probability that global corporate earnings could decline significantly more than the market is currently forecasting, and potentially more in line with what we saw during the GFC. So, given deteriorating economic backdrop and a worse than expected corporate earnings outlook, will markets consolidate lower from here and potentially retest or even push through the March 2020 lows? We've seen the sharpest sell-off in history, followed by the sharpest recovery in history so far in 2020. But when we look at other major bear markets in history, all of them retested their initial lows and eventually found new lows once the panic had subsided and the government stimulus or sugar hit had waned. In our view, we do not expect this time to be any different, and accordingly, we are expecting markets to weaken further from current levels. We are witnessing an ensuing battle between the worst recession that we have seen since the 1930s, depression, and the most aggressive central bank and government stimulus we have ever witnessed. For now, it appears that the bulls, backed by the central banks, have the upper hand, and markets are pricing in a V-shaped recovery for corporate earnings, economic fundamentals, and broad-based markets. The chart on the left here shows that both global GDP and corporate profits are expected to fall sharply in Q1 and Q2 of this year, but also rebound strongly in the second half of 2020 and into 2021. The chart on the right shows that emerging markets, represented by the orange line, have experienced a V-shaped recovery, which has largely been led by China. However, the reality is that developed markets, as represented by the blue line, have not seen a V-shaped recovery as yet, and their data continues to deteriorate to levels much worse than expected. Based on this, there appears to be a disconnect between economic fundamentals and market valuations. Why is this so? The answer is that global central banks, led by the US Federal Reserve, have pumped so much money and liquidity into the system that they've effectively backstopped the markets and provided a floor. Why should markets keep falling when the Fed has said that they'll expand their balance sheet to whatever level is necessary? In addition to the massive global central bank stimulus, governments around the world have injected unprecedented amounts of fiscal stimulus into the system. The chart on the right shows how much money the Australian government has pumped into the economy relative to previous historical crises. And this level of stimulus has resulted in renewed optimism in markets, but less so for consumers and businesses. So, as we look ahead and ask ourselves the question, should we be positioned for a bullish or bearish outcome in the short term? In our view, we need to be positioned defensively in anticipation of more downside. The stimulus relief rally is largely played out. Corporate earnings forecasts are too optimistic. A V-shaped economic recovery is not realistic. The global economy will take time to restart, and probabilities suggest that we retest the March lows, and we're about to see negative feedback loops play out throughout global economies. But that said, our short-term bearish outlook provides a great medium to long-term bullish outcome for investors, and I'll explain why. In previous recessions, corporate earnings took a lot longer to recover than markets are currently expecting. This suggests to us that any earnings disappointments are not currently priced into markets, and the current expectations for earnings to rebound strongly in the second half of 2020 are optimistic. That brings us to the negative feedback loops that we've previously referred to, and we highlight 4 of these today. The first negative feedback loop is unemployment. As unemployment rises, consumers stop spending. On Friday, we will get the US unemployment number for the month of April, and expectations are for somewhere around 16% unemployed, with the last 5 weeks seeing all of the jobs created in the last 10 years wiped out, as shown in the chart on the left. The chart on the right shows the Australian unemployment situation, with expectations for a 10% unemployment rate this month. In our view, both the US and Australian unemployment numbers could be even higher, and as such will have a significant impact on consumer spending and sentiment going forward, with many of these lost jobs not returning even when lockdown measures are eased. Negative feedback loop 2 refers to the wealth destruction that has occurred within share markets, falling and ultimately impacting the ability of consumers to draw on their savings and investment assets to fund purchases and also discretionary spending. Low interest rates for a prolonged period of time also has an impact on retirement savings and the willingness of investors to spend money. Negative feedback loop 3 refers to the loss of wealth as property prices fall in value, or at the very best stagnate in value. It's hard to forecast an environment where property prices do not fall when unemployment is at double digits and there is significant financial market stress due to an unprecedented global economic slowdown. As people start to see their property equity disappear, they will be more reluctant to spend money. Negative feedback loop 4 focuses on the expected decline in business capital expenditure. And as these charts show, when business and consumer confidence collapses, then spending will likely follow. It is all of these negative feedback loops that, in our view, combine to create a massive spending gap that will result in a more prolonged downturn and either a U or an L-shaped recovery, as opposed to a V-shaped recovery that the markets are currently anticipating. So what does this mean for investors? MPW has been positioned defensively into this crisis, and we have also been increasing cash recently with the aim of selling any investments that had either not fallen in value or no longer provided a compelling reward to risk outcome for investors. Accordingly, we are holding a lot of cash for investors in anticipation of deploying this cash into our highest conviction strategies in the coming months. From a portfolio strategy perspective, right now, cash is king. We are overweight to cash. Our expectation is for the Aussie dollar to move back towards 60 cents against the US dollar, and this will be the time to hedge all global assets. We don't see any value in government bonds with yields under 1% per annum on a 10-year bond. Corporate credit is starting to look interesting, but we're not quite there yet. Listed property and infrastructure valuations aren't compelling at current levels. We're neutral on equity absolute return strategies such as long, short and market neutral. We're waiting to see better valuations in Australian and international shares before increasing exposure. And we're now underweight to neutral on alternative assets, but will selectively look at opportunities as they arise in this space. I'll now provide a more detailed overview of the high conviction strategies that we're monitoring and looking to deploy our surplus cash into in coming months. We're not holding cash for long-term returns, but rather for short-term capital preservation, and more importantly, for optionality to selectively buy into cheap markets for long-term outperformance. We don't see this position as being overly risky based on our view that markets are likely to trade lower in the short term, with downside risks outweighing potential upside returns from current levels. Defensive asset exposure has traditionally been taken by investing into government bonds, which have been seen as the risk-free asset given that developed market governments will generally not default on their debt obligations. We would argue, however, that buying a 10-year government bond on a yield of less than 1% per annum is no longer risk-free in real terms after adjusting for inflation. And these assets also no longer provide the same level of diversification in portfolios as they historically have when interest rates were much higher. Therefore, their defensiveness within portfolios needs to be questioned on a medium to long-term basis. Our preference for the defensive part of your portfolio today will be in senior secured corporate credit rather than government bonds. Whilst these securities are considered much higher risk than a government bond, if we can purchase them at the right price, then we believe that the reward to risk is far more compelling than holding government bonds. The chart on the left shows that credit spreads in the US blew out to 1,100 basis points in March, when markets were at peak fear. And while spreads did not blow out to GFC levels, they were very high on a historical basis. The chart on the right shows the same credit securities, but on a shorter time frame, with spreads blowing out into mid-March before the US Fed announced that it would buy investment-grade credit securities, and subsequent to that, they would also buy some non-investment-grade credit securities. As a result of the Fed support, spreads have fallen, as we can see in the right-hand side of that chart, but still remain elevated to reflect the higher risk that is now in credit markets. Whilst credit spreads have not widened to 2008 GFC levels, their valuations are now much more compelling than back in December of 2019. This table shows that US bank loans or non-investment grade credit securities have fallen in value by around 10% into April, whereas during the GFC they fell around 29%. The current yield on these securities today is around 7 to 8% per annum, which is attractive in a low interest rate environment. That said, given our view is that equity markets could retest their March lows in the coming months, we would also expect credit spreads to widen further in this environment. And ultimately, that will provide our opportunity to start investing into US senior secured bank loans. We do not expect valuations to be as compelling as what we saw back in 2008. However, we believe that a discount of around 20% to par value would be a very attractive entry point on a long-term basis. And that's the type of value that we did see in the depths of the March 2020 lows. It is our intention to tranche into credit strategies, as we do not expect to pick the bottom of the market. Rather, by tranching in, we'll be buying into a bottoming process that will generate long-term value for client portfolios. This table shows that when non-investment grade credit spreads widen to 900 basis points, which is where we've recently been, returns from this asset class have been very strong over a 1 to 5 year basis. And we believe that this time will be no different. It must be noted, however, that as we buy into these assets, returns could look very poor in the short term, but we need to look beyond the short term and focus on long-term risk and return objectives as we start tranching into these securities. Within the equity and alternative asset classes, we also think that commodities are becoming compelling at current valuations. As shown in this chart, whenever commodity valuations have reached these types of levels relative to equity valuations, we've witnessed very strong commodity cycles thereafter. Out of this current crisis, we could witness the next commodity super cycle as governments start announcing large fiscal infrastructure stimulus programs. Large fiscal deficits and unlimited quantitative easing should support the gold price, and whilst deflation is more of a concern in the short term, we believe that the massive liquidity injected into markets will eventually reflate the global economy, and this will be positive for both gold and oil prices. Oil in particular represents extremely compelling long-term value relative to equity markets. And we are currently reviewing opportunities to access this sector should markets and oil prices move lower in the coming months. These two charts here do show and do highlight the compelling valuations relative to history of oil relative to the US share market and oil and gas services stocks relative to other sectors. So we're taking a much closer look at this. The sell-off in Australian and global small companies has also been quite large, and should markets retest the March 2020 lows, then valuations down at these levels will be very compelling. The charts shown here confirm that small cap equities, which is shown in the blue bars, typically fall by more than large cap equities during falling market environments, but also rise significantly more during market recovery periods. So the charts here really confirm that small cap equities are likely to provide strong outperformance relative to large cap equities into the next recovery cycle, and that's where we'll be looking to allocate capital. We're also looking at the US tech sector and emerging markets. US tech will largely drive the world going forward. It's not just US tech, it's global tech. We've seen US tech recover strongly from the lows. It also sold off quite hard. And should we get a retest of those lows, we think that that would be an area of the market that we would find compelling to outperform the broader S&P going forward, as it has done over the last decade. So again, that's another sector that we're looking closely at. Emerging market valuations are also very compelling relative to developed market valuations, and we think that that will be a place where we will want to allocate for the very long term to generate returns as emerging markets start to outperform developed markets, and that will likely have catalysts when the US dollar has peaked and starts to fall. That will be a real tailwind for emerging markets alongside their already cheaper valuations. So that provides a broad overview of the strategies that we are looking at. And today we've highlighted that the economic outlook is dire in the short term, but this will provide great opportunities for investors who are prepared to be patient and take a medium to long-term view. MPW has been a seller of assets recently with the aim of increasing cash ready to buy assets that provide strong risk-adjusted returns. We're not trying to pick the market bottom. Rather, we're focused on selectively buying assets that offer compelling long-term value. During this process, we fully acknowledge that this could be quite painful in the short term to the bottom line of many portfolios should markets continue to fall whilst we are buying into them. But the long-term outcome for investors should be very rewarding, and that is what we are focused on, buying good long-term returning assets. So I'll leave it there for today, and I'd like to thank you for taking the time to listen to this briefing. Hopefully you've now got a better understanding of the opportunities that we are looking at for your portfolios, and we are monitoring these on a daily basis with the objective of looking to deploy the surplus cash that we've raised in the coming months as these markets start to, or should these markets retest lows and give us a much better and more compelling buying opportunity than where markets are currently priced at. So we'll leave it there. As I said, thanks for taking the time to listen in. Stay safe, and we'll be in contact with you shortly to discuss your portfolios. Thanks again. Bye.